Welcome to this very special edition of the KAJ Masterclass Live, the show which ensures that you profit from your time spent here with experts, either through the industry insights, information, or simply learning from them. And today we have Patrick Grimes, CEO and founder of Invest on Mainstream, and he's also on the Forbes Real Estate Council. Welcome to the show, Patrick.
Glad to be here, Jay. I'm excited about it.
You are welcome. You're welcome to the show. You are welcome to India. And I'm sure not just in India, but a lot of people, not just in the US, but also in several parts of the world will be benefiting from what you are going to, share with the audience. So my first question to you, Patrick, is to understand from you is that you started your real estate investment in 2007 and you are still going strong. So what 2007 did not impact you much, and now you are as strong as ever. So what is the reason for your success? Is it luck? Is it that you are much more smarter than a lot of other people? How does it work? On this front. And second thing is along with that is that earlier people used to say that you invest on Wall Street. Now you're talking about invest on mainstream, on back alleys, Front Street, wherever it is, and you are putting a lot of money in every real estate investment as possible that works for you. How does it work? Help us understand these two parts of this.
Sure. Well, I think like most people who have been successful, they work hard, they fail, they learn from their mistakes, and they move forward. And I'd say that's probably what's very, very common with me. I mean, I started out as a machine design, automation, robotics engineer. And I immediately, back graduating college, got some advice to invest in real estate. I did invest back right before the last big boom or bust, and I lost a lot. I was investing and speculating and trying to make it big, double and triple my money every year or two. Unfortunately, I didn't know about buying for cash flow. I didn't know about getting low leveraged. I didn't know about recession resilience. And back in 2007, market was never going to go down. And so I ended up writing it down and dropped through foreclosure. I was in pre-development. It took me quite a few years to recover from that. But I came out fighting, got a master's in engineering and business, started doing some really cool projects with companies like Tesla, SpaceX, Lockheed, Johnson & Johnson, doing automated assembly systems. Then I was like, well, where am I going to invest? I figured out all the mistakes I made and how to invest in real estate at a more conservative, be the tortoise and not the hare. And that's what led me back in. And I was able to be successful, starting out incrementally, single family homes, and then scaled them up into larger apartment buildings, diversified into energy. And now we're launching off into a recessionary acquisitions phase where we're launching a fund specifically about picking up great deals in the recession this time, whereas last time I was writing it down. This time I have a strong portfolio that's carrying me through it, and we're getting cash heavy, and we've begun start to acquiring some excellent deals this time.
Right, Patrick. $416 million portfolio, real estate portfolio, and including 3,000 plus units across the southeastern United States and Texas. So help us understand what is your company Invest on Mainstream is all about. We will also talk about automation systems because I'm quite intrigued by the fact that person from robotics and suddenly developed an interest into real estate. Means these are two things and very, very different things. Help us understand this part also. Was real estate very profitable to you at that point in time, or you just went in for the speculative nature of it at that point as it existed?
Well, so the advice that I got when I was just a young snot-nosed engineer was from one of the founders, and I talk about him in my book, who said his only regret after having built this wildly successful high-tech firm, his only regret was not investing more sooner into real estate. And that stuck with me. I read Robert Kiyosaki's Rich Dad, Poor Dad book. I learned about the cash flow quadrant and buying assets and not liabilities. And I didn't come from a wild, lavish upbringing. And so when uh, I started making money, I was like, well, where am I going to invest it? And so then real estate became a side hustle for me after I lost it all. And I was moonlighting single family, buying in recession resilient markets, homes that needed some renovation, that I could get my capital out and immediately begin renting for cash flow, not getting high leverage debt, keeping it very low leveraged, and building what I thought was going to be 20 or 50 homes. And then I was going to retire, when I realized that I can't do that and be a high-tech robotics engineer. It was too much, because I couldn't get married. I was like constantly traveling around, and I was getting two master's degrees while moonlighting this stuff out of Texas and living in Southern California. And when I met my wife, I told her I was going to take a break from single family. And then when I scaled and I said, look, I got to scale up. I've got to do things. I got to partner. I've got to do bigger assets. I got to partner with people that are in the markets. So we're taking down things together. I don't have to do it all on my own. And that's when I built Invest on Main Street. I said, look, we're going to build a private equity firm. We're going to raise capital from others. We're going to partner with different individuals that have different disciplines in different areas. And we're going to build a diversified portfolio throughout the recession resilient markets. And so Invest on Main Street kind of came out of that, me graduating from the do-it-yourself DIY single family guy to a larger institutional approach to calculated risk-averse investing at scale. And yes, it became more profitable than engineering. And I am a huge nerd, love engineering to death, took apart VCRs, played with Legos growing up. I don't think I'm ever going to get over that. But what became much more profitable and the right thing for my family, which freed our time and our location. We moved to Hawaii during COVID, spending 3 months in Hawaii again this summer. We have a newborn, and I get to spend every day with him. That life was brought by succeeding in real estate and also in the energy portfolios that we're in as well. So that's why.
That's why. So, someone who has seen the lows and someone who is seeing the real estate as it is from 2000, surviving 2008, and now looking at the future in 2023, and with the state of the interest rates at this point in time, what would you advise people who want to put money into real estate? Is it the best of time, or is it not so good time for real estate investment? How do you like to put it for people who want to look at real estate, either for quick money, or in terms of some sort of a retirement planning? How should one understand the market as it is at the moment and the way it is shaping out?
Well, so the traditional deals, the passive investments we put together, large 1 to 300 unit multifamily acquisitions in various locations in the southeastern United States, those kinds of investments have gone from being a bit of a needle in a haystack to almost non-existent now. It's almost impossible to find in the way that we were looking for them before. If you're and we're still headed for some pain in the United States. I think that with the interest rates just going up again, the Fed's rhetoric is not lessening. They're still going to go strong. There is more banking issues to happen. My general sense is, if you see any investments that look today like they did a year ago, they're packaged the same way, they have the same returns, they're saying the same things, those operators have their heads in the sand. and somebody who's lost everything in 2008 and 9, I know what it's like to be in that situation when I was the guy with my head in the sand, right? And I was buying into it's never gonna go down, it's never gonna go down. Today is the time to be shifting focus towards how can you lean into the recession, just like how a lot of people made it very, very well in 2009 and 10. They completely shifted their strategy. And that's why we have a completely different acquisitions engine that's looking for distressed assets. These are people that are had a hardship because of the recession. These are individuals which didn't have an interest rate cap and had floating debt. That means all their cash flow is gone, probably in the red. These are people that their tenants are not paying their rents, right? Because COVID delinquencies are still super high and the courts are backed up evicting. That's happening all over. These are people that maybe a combination of those having a natural disaster happen. What we're finding is the recession with the jobs lost, delinquencies, interest rates, also insurance has gone up 20 to 40% around various places in the United States. All of these things aggregate to these various operators that we're finding, and we're going through 1,000 leads a month right now. We're finding like 200, we're actually investigating 200 properties a month. And we're finding a couple deals a month now where we can pick up these properties at extraordinary discounts, not just a 10 to 15% average annual return, but extraordinary discounts to the point where we could get our capital, out, we could buy it and get our capital out in 6 months to a year. That's what we're seeing. So we're getting some of those investments now that are similar to what you could do in 2009 and 10. They're not as prevalent as they were in 9 and 10, but that's why we started this recessionary acquisitions fund, because that is where I think investors should be leaning today, is looking how can they benefit from the recession.
Right. So two aspects of it. One is the wealth building part. So as an individual, how does one see the real estate market at the moment? And second thing is, even in terms of retirement planning, a lot of people are very cautious, especially if they are 40 plus or around 50, and they don't want to take any risk. And right now, as you said, with the state of the inflation, with the rising trend, and I guess maybe this is not the last that they have done. You never know about these things, even if whatever they say, situations can turn different in very. And again, the market scenario is different. The war in Europe is still on, and nobody is quite clear how things are panning out, and everything is so interrelated. It can impact one thing, and then another thing can just get impacted strongly. So as an individual, how should I look at the real estate market in terms of my wealth building? Is it the right, what should be the strategy here? And second thing is, in terms of my retirement planning, does it fit or does it not fit? Is it only fit for in terms of only if you are wanting to get into using that real estate property or apartment or whatever it is for your own use, or maybe I'm not getting the full sense of it. Help us understand. A lot of people in India also want to, there's a huge number of people who are in the US, and people also put in a lot of money there. So how should they look at it if they have some spare money and they want to put into that market?
Right. Well, so I get this question a lot. And the interesting thing is that, especially in America, and I don't know so much in India, the financial IQ is very, very low when it comes to anything outside of the stock market. People, they think of investing and they think of, well, the de facto place to invest is in your 401k or IRA. I'm sure you have a variation of qualified retirement accounts in India, which is basically all stock market. Maybe they've graduated from a 401k to IRA. Maybe they've graduated to a financial planner. Once again, put them all inside of securities, into the stock market. Or maybe they're doing a DIY kind of venture out and buy their own rental property. Well, I saw myself struggle with that. I wasn't the expert. What I'd say is that coming from a guy with 2 master's degrees, my 3rd master's degree, where I learned to invest passively into commercial, that's where I found the sweet spot. I think that when you invest for retirement, you need to invest in recession resilient markets if you're going to do in real estate, right? Those are markets which tend to not go crazy, like the Las Vegas to New York to LA, markets that are stable. You need to invest in investments with very low debt. Like in our opportunistic fund, we're looking at 50% leverage. What does that mean? That means we're really cash flow heavy. That means we cash flow on day one, and that provides for capital preservation. When you get that debt, what's happening now is a lot of people didn't get fixed interest rates, or they didn't get interest rate caps. So you need to make sure you're investing in a way where your cash flow is not going to get consumed. And then you need reserves on the sideline. You can't spend every penny just to buy the asset. We keep in a reserve account 6 to 8 months worth in reserves on the sidelines. That means if a tornado comes and hits, we're well insured, but you still have to float the property. And it's people that, even though they're insured, they didn't have the capital on hand to float the property while they waited for that to come to, and then they lose it, right? So it can be, just like in any kind of investment, it can be a very low risk, capital preserved investment when the deal is structured properly and in the right market. And if you read Forbes, Patrick Grimes' Inflation, you can read my article on this is exactly how I think income generating real estate, when structured properly, and the assumptions I just explained, can actually allow you to win with inflation. Meaning that when inflation goes up, income goes up. Now expenses go up too, but our expenses are less than our rents. And so oftentimes we're at least hedged with inflation, if not earning more, provided that we get steady debt. And back when I was born in the early 80s. And back then interest rates were double and triple what they are now. What was happening in real estate? People were making lots of money. How is that possible? Well, and the deals were structured differently. There wasn't a lot of panic and fear, and people were calculated at how to make it work. And I think that it's important to keep in mind that you can make money in real estate in any economy with double and triple the interest rates we have now. But you've got to find the right operator to invest with. And when you do that, you will outperform the stock market. You'll provide tax advantages and inflation hedging and capital preservation. So I highly recommend, I think it's perhaps the most valuable tool available for retirement planning, but it requires quite a bit of information to do it on your own, or you can passively invest with an operator like somebody who's been through a downturn that speaks the language of failure and recovery and is kind of on their own soapbox doing things in a very different way, and is patient with the returns. We're not saying you're going to double and triple your money every year. I mean, I'm an example of what happens when you try to do that, right? Reasonable, calculated growth over time is the key.
Absolutely. And if there is somebody who can handhold them like you can, then there's nothing better than that. And if it is available, then people should make use of that. So do tell us, tell the audience about your Invest on Main Street. What it does, who are the people who can approach you, your company, for their planning, for your advice. And second thing is you started the real estate investment as a side hustle. Is it still lucrative as a side hustle even at this point in time?
Well, no, Invest on Main Street's it's a real private equity firm, not a side hustle anymore. I left behind actually during COVID, I did engineering, and I actually did automated COVID assembly test kits. And it was really cool to be involved in that. So I am still a geek, but no, I'm not doing engineering anymore. This is my one and only gig. It is Invest on Main Street. We put together investments for accredited investors in the United States. That's somebody with $1 million in net worth, not including their personal residence, $200,000 in income as an individual, or $300,000 when combined with their spouse. And that's the SEC requirements. And we're just kind of obliged to verify that. Our minimums are like $100,000. So we kind of make that bar a little bit high. But sometimes we're raising anywhere from $4 to $30 million for some of the acquisitions. It does make it tough. If anybody doesn't meet those requirements, but they're still interested, you can still set up a meeting. I'll point you to others that don't have those requirements, but you'll never hear them on a podcast, because if they don't require the investors to be accredited, they can't talk about their investments publicly. So it's a little bit of a chicken before the egg thing here. But my general sense is, in individuals that are busy professionals, I'm really passionate about helping. I was and have been one my whole life, working hard tirelessly, trying to get out of the grind and the rat race. I'm super passionate about helping people invest in ways to meet their goals for accelerate retirement and live the retirement of their dreams while building their legacy so that they can leave something to their kids. Happy to help point you in the right direction if that's what you're doing. If you're out there trying to do the DIY, do it yourself, real estate guy, I feel your pain. I went through all that, and I'm happy to chat with you. And I have articles, a bunch of stuff, bunch of content on my website that talk about some of the risks associated, asset protection problems associated with that strategy that the gurus aren't telling you about, and how to structure these investments, especially these passive ones that don't require you to take time from your family, friends, and hobbies, allow you to go enjoy your life, but use this money-making machine and maximize its potential with diversified portfolios of investments. That's really our niche. And our goal with Invest on Main Street is to kind of raise the awareness. We're fighting against the employers, which say, hey, put some money in your 401k, we'll match it, that makes it a good deal. What you don't know is inflation is affecting that. The market volatility is affecting that, and you're not going to make it out. And you're not going to have anything left after you retire and pass. And we're fighting against that. We're fighting against all the financial planners, which don't make money from our investments. They're going to put you into all these things they make money on, but they can't make money on private real estate offerings, private diversified energy funds. So they're going to fight you on that. The reality is we're not a secret. The wealthy invest in ours. In fact, some of our investors are incredibly wealthy. We're passionate about bringing it to the working professionals, the accredited investors, the doctors, the dentists, the entrepreneurs, the managers out there that realize or is fearful of the traditional path of investing, realize it's never going to get them out, and they want to diversify into inflationary interest rate protected type vehicles, and we can provide that. And that's why it's there, and that's why I'm doing it.
Absolutely right. So, do you ever get the fear, or have you ever thought of de-risking, or you have already done it in a situation like 2008? Does it ever occur to you that 2008 situation can come again, or do you think that it's not a probability right now?
Oh, well, 2008 happened again. Of course, I think it. Well, so each recession is a little different in its own way, right? There are fundamentals about 2008. 2008, more so than a real estate crash, it was actually the biggest incidence of fraud in the country's history, where the banks were essentially criminals. They were not verifying income. They were not verifying credit. They were falsifying in documents and then selling them as prime securities. So that was fraud. That wasn't just a real estate crash. And even though things look a little bit shaky right now, believe it or not, that part where we have verified income, verified jobs and credit, that's for the most part, that's been fixed to a large degree. So we're not going into a recession where people simply can't pay their bills. That's not happening this time to the scale that it was before. We have much more qualified buyers in the market, much more qualified people that have the ability to pay their mortgages going into this one. There are other things that will affect different credit crunches. And the government will adapt. I mean, during COVID, we saw, even for our multifamily deals, which tend to be the lowest risk assets in real estate, we saw the bridge lending or the banks dry up, and we used Fannie and Freddie. Congress has created Fannie and Freddie to provide debt. We'll see stuff like that. We're going to see a credit crunch coming up in the next year or two. That's going to create a lot of opportunities for a recessionary acquisition strategy like we have, but it's going to cause a lot of pain for others that weren't prepared for another 2008. I think it was it Napoleon that said, I never want a war that went to plan, but I never want a war that I didn't plan thoroughly. So my general sense is when we look at the underwriting, it's kind of like when we look at the projections and the pro formas of our properties, it's kind of like we're going to go to battle. We don't know exactly the nature of the crash that's going to happen, but we've seen from the past what it was required to be resilient through those delinquencies, debt, interest rates, insurance, maintenance, natural disasters. And so you can build these properties around these, fortify these investments around all the disasters we've seen. And then we're going to be agile, right, as we go through it. And so I think it's, of course, there's going to be some kind of cyclic market, and that's part of capitalism. But it doesn't mean that those that don't plan thoroughly aren't going to win that battle. Meanwhile, you're much safer in a real asset, capital preserved real asset that cash flows, than you are where your capital's, where your investment's still there. Maybe you're just playing with the distributions. Then you are in the stock market where overnight you lose half or more of your equity in a crash, right? So my general sense is make sure you got the right partner to invest with, but make sure you're diversifying in those recession resilient, inflation hedged assets, because there may be another 2008 type of investment coming up.
Right, right. There is so much to learn from you, Patrick, and especially, somebody who has got good educational background. You know so much about automation. You design robots, automation systems, and all that stuff for for other people. So, how do people connect with you? You have also written a book, Persistence, Pivots, and Game Changers, Turning Challenges into Opportunities. So, how do people know more about you? What's the best way to connect with you?
Sure. So invest on mainandthenstreet.com. Invest on mainandthenstreet.com. Happy to chat with you. If you go there, click on contact, set up a call. I'd love to hear about your story, get you pointed in the right direction. We have investments coming up at the top of the website. Our book is Persistence, Pivots, and Game Changers, Turning Challenges into Opportunities, forwarded by Brian Tracy. I'm on here. Phil, I did this with a couple other really awesome guys. Phil Collins, lead guitarist at Def Leppard, some NFL, NBA coaches, players, entrepreneurs, actors, some really cool people in this book. I did a chapter. I tell my whole story, and it did make an Amazon #1 bestseller. Happy to give it away. This is part of my contributing back out there to try and inspire others down the path. So if you just go to investonmainstreet.com/book, investonmainstreet.com/book, and I need a promo code from you. What do you want your promo code to be?
You can make it KAJ is perfectly all right.
There you go. So include that promo code there. Make sure you fill that out and set up a call if you'd like to have a chat, and we'll get you a signed hard copy of that book sent to you.
Right, right. My last question to you, Patrick, is that a person from automation, your automation systems, how do you manage the real estate part and the automation systems company together? Because both things must be, it needs a lot of your mind space, as well as your time. So how do you manage it in terms of as an entrepreneur, as a person who's taking care of both the companies? Even one simple thing is very difficult in today's situation. Or have you put it all on automation?
No, I just have an AI that I use for it all. No, so I did leave the engineering stuff behind now. So thankfully, I can spend time with my wife and my boy, as well as my company, where my passion now is Invest on Main Street. But it wasn't easy. I tell you what, just doing the machine design, automation, and robotics, those were very challenging projects where I would go into these facilities, brilliant people coming up with these crazy ideas, and we'd have to build these machines one of a kind each time. And that was a lot of stress. It was, the first product was a prototype. It was not easy. And I was flying around constantly when I spent a lot of years getting 2 master's degrees while doing that full time. So I've never been one to let it go, but it paid off, because on the other side, I was able to kind of create more value, and I was able to get paid more along the way. And then, like I said, it was when I learned to partner in the real estate, because I was moonlighting my real estate career. And it wasn't until I learned to partner with others and bring my superpower, what I was really good at, the analysis, projections, the underwriting. I'm a bit of an analyst, travel out, figure out these deals, and then work with others that had spent 20 years property managing and asset managing investments and in specific markets that I'm investing in, and partner with others to work on these deals together, was when I was able to get really do it in a healthy way. I was able to do the engineering and then scale a real estate portfolio to the point where I could walk away from engineering. And that's really what it took. It's to let that control go. And that's the challenge with all passive investments, right? De facto, people think, oh, I can invest in the stock market passively. But when it comes to buying a real estate deal, oh, I want to do it myself. Well, that didn't work for me. I had to partner with others to make that work. And so that's my general sense of advice.
Right, right. You advise a lot of people, and life on the main street also can be sometimes very individual and lonely also sometimes. So, who do you go for advice for?
Well, I'm in a number of masterminds. I'm masterminds meaning I get invited to a small group of people, and
Right.
I have about 3 of those that I attend regularly, and they're all alternative investments based. So different operators in different spaces. We're kind of a peculiar group, right, of people that and we're all navigating similar challenges. So I get it, and many of them are far more experienced. They have a lot larger portfolios, bigger teams, and I'm just very fortunate to be at the table. So I attend a lot of that, and that accountability has been big. There was a time, especially when we were living in Hawaii during COVID. It was my wife's idea. She was like, let's move to Hawaii. 2.5 weeks later, I had us on a plane. I was like, all right, that's your idea. We're going. Anyway, so we're out there. I was actually waking up, I think at 4 a.m. Hawaii time, right? Because it's a 6-hour time change to the East Coast. And I was waking up at 3, going on my run, taking a shower. I run every morning. And I would be in this mastermind at 4 a.m. It's dark. And I did that every single Monday for almost the entire time I was there, because I valued so much that connection. And I guess while I'm on that, I do run every single morning, and I did the lake right behind me. I ran around that with my puppy, and I listened to exclusively a combination of podcasts, TED Talks, and Audible books while I'm doing that. And that inspiration, the constant, and it's self-improvement, investing, management, CEO, those constant engaging and putting into work some of those principles that I'm learning is just an amazing thing. And if I might recommend a book, can I recommend a book? Is that okay?
Of course.
Is it okay if it's not my book?
It's okay, no problem.
Yeah,
Any book, book is knowledge, and now it's my show is also about knowledge.
So real time, and I tend to think fast, and I probably talk too fast too. Apologize for that. I get that feedback. So I usually listen to these books at like 1.5 speed, right? And then I'll go through it again or again, sometimes 2 or 3 times. But this book was the first book in years that I dialed it from 1.5 to 1.25, and then I dialed it from 1.25 to 1 speed. And it's a CEO only does 3 things. A CEO only does 3 things, and it's by Trade Taylor. He runs a family office. He's just an extraordinary individual. I've had the opportunity to work with. And if you're real serious about managing a business, then you've got to read this 3 times or listen to it 3 times, because he's got so much, it's deep, rich content with such great historic references. And it talks about like the tribal sense of the whole and the ritual sense. It's just, there's so much good stuff. I highly recommend A CEO Only Does 3 Things. It did just recently come out, so you probably haven't heard about it, but I'm super impressed by it. It's an example of one of the books that's making a fundamental shift in my management strategy that just comes from carving out the time to run around the lake with my dog and kind of meditate on some self-improvement.
Wonderful. Thank you for all your views on investing on mainstream. Patrick, and I can also tell you that from what I see from here, there is certainly a great view, even on the street that you live in, and in the backdrop, I can see that great view. I hope even for the investors, even for all those people who invest in real estate or any other place, there is always a great view for them. There is always a great view of the future for them. So with this, it's a wrap on this very special edition of the KAJ Masterclass Live. Thank you so much indeed for joining us.
I appreciate your time, and Jay enjoyed it so much.